Hi, I'm Jimmy. In this video, we're going to walk through a quick review of where the US economy stands. We're going to use different economic indicators to see if we can objectively gauge where the economy stands today. The goal here is to see if we can get enough of a big picture perspective to help us make better investment decisions and ideally get us closer to our personal goal of achieving financial freedom. Okay, let's jump right in. So I think it makes sense for us to start by looking at where the money is going. Now, exchange-traded funds publish how much money goes into them and out of them on a regular basis. And if we look at a large group of some of the largest ETFs, well, we can see where many investors are actually putting their money. So as we can see here, in 2017, well, the amount of money that went into equity ETFs was significantly larger than the amount of money that went into bond ETFs. Equities are the same thing as stocks. So those are stock ETFs. So clearly, a lot of money went into stocks during 2017. And when we add 2018 to this mix, well, in 2018, there was still much more money going into stocks than there were going into bonds. But now, when we add 2019 numbers, well, now we can see for the first time in the past couple of years, well, bonds, also known as fixed income, well, they took a much larger percentage of the overall investment dollars. Now, the question now is this movement of money into bonds, is that a flight to safety? And if that's the case, are people worried about the stock market crashing and therefore jumping into the perceived safety of fixed income investments versus your typical stock investment? So overall, this could be a negative thing for the stock market. So jumping over to our economic scorecard here, well, here I think it makes sense to give a point to the bears. Clearly, this is a negative thing, although I do think it's important to point out that in theory, a lot of this money that went into bonds could one day flow out of bonds and into the stock market, which could hypothetically drive the stock market higher. So although it's a negative point right now, if the economy strengthens, if this was a flight to safety, if people become less nervous about the market, perhaps they come into the stock market and leave the bond market. But overall, I think a point for the bears makes sense for this one. Okay, moving over to consumer confidence. Now, consumer confidence has been on the positive side of the economy for quite some time. And when we look at this chart, we can see that it looks like consumer confidence continues to be a point of strength. So clearly this is going to be a point for the bulls. Now, the last time I brought up consumer confidence, a few people commented that consumer confidence is actually a lagging indicator. And I've personally seen consumer confidence referred to as a lagging indicator and a leading indicator. But just to try to provide a more fact-based assessment, going back to the Great Recession, well, this is where consumer confidence was when the stock market hit its peak. And all the way down here for consumer confidence, well, the stock market at that point was only down about 15%. And considering that the stock market continued to fall to more than 50% down, to me, it seems like consumer confidence did a pretty good job of warning us that things were getting worse. So take that for what it's worth. Either way, it looks like this should be a point for the bulls for now. Okay, now we move over to the housing market. Now, this is a chart of new housing starts, which is basically how many new houses are getting built. And in theory, the more robust of an economy we have, the more people buying houses. So the more houses that they have to build. And as we can see, housing starts seem to be doing a decent job. And clearly, this is going to be a point for the bulls since housing appears to be strong. Now, we may not be too surprised that housing looks to be doing okay, because if we recognize the fact that the Fed funds rate has been lowered a few times by the Federal Reserve. And since this interest rate is often tied to longer term rates that ultimately control the mortgage rates, well, it would make sense for housing to do well, since in theory, they are cheapening the cost of buying a house, so more people should jump in and buy them. Either way, it looks like both interest rates and housing is a positive point for the bulls right now. But sadly, for anybody getting excited about the strength of the economy, now we move over to the manufacturing sector. This is a chart of the ISM manufacturing indicator going back to 2013. And for those less familiar with this indicator, well, the key level here is 50. So during this fall here, well, manufacturing, the sector itself, was still growing, albeit slower as it declined down the line. But once we got below the 50 level, well, now it means that the manufacturing sector is actually shrinking. So clearly, this is a bad sign for the economy. And for that, the bears get a point. But if you're curious about the history of manufacturing, or at least from the history from the Great Recession, this is a chart of the ISM manufacturing sector and the S&P 500 going back to the Great Recession. Now, the information here wasn't as clear as I was hoping it was going to be, but I think it could be quite useful. Overall, this was the peak of the stock market. And don't forget, we can't forget that the 50 level is the important level. So we can see that manufacturing was weakening, but not going negative like we're at today. Now, it did dip negative here, but that was after the stock market started dropping. But to me, I think it's interesting that the manufacturing was certainly declining as we were leading up to the stock market crash. So if nothing else, I think that manufacturing is certainly worth watching. And I know that the Federal Reserve has been watching manufacturing since they've talked about it a few times as one of their key drivers for why they're lowering interest rates. So on our scorecard, clearly manufacturing gives a point to the bears there. Okay, now we've got another interesting economic indicator that focuses on the debt of everyday Americans. So this is a chart of car loans. It's the percentage of car loans where people are more than 90 days or more late on their car loan. Now, I used a longer term chart here so we can see going back into the Great Recession. And clearly the fact that this line is rising is a bad thing for the overall economy. But you want to see a different, interesting chart that really blew my mind? So this is a chart of the same data, the car loan, how 90 days or more late, going back to 2003, which is as far back as I could find. The orange line is the S&P 500. But what we can see here is that right here is the high of the S&P 500 leading into the Great Recession. But look where the auto loan payments were. They were about 2.8% of car loans were 90 days or more late at that time. Now, I'm sure we would expect that as the economy slipped into a recession, well, more and more people would become late on their car loans. That's exactly what we would expect to happen. But what surprised me is as the economy recovered, well, loan payments got better. That makes sense. But then in 2014, well, car loan payments started getting worse again, and the stock market didn't seem at all fazed by it. So cleaning this up real quick, obviously this is going to be a point for the bears since this is a bad thing that this is getting worse. But I'm a bit surprised that this isn't a bigger problem for the overall economy, or at least it hasn't been up until this point. Now, I have to assume that at some point, this is going to catch up to the economy, but we'll ultimately see. Maybe it gets better and the economy isn't fazed by it, but I would think this is something that would eventually get to people. So now to answer the question, do we invest now or wait for the stock market to crash? Well, personally, I think the best move is to be a long-term investor and to invest as frequently and as often as possible. Sure, we're in the longest bull run in history, and eventually there will be another market crash, but I'm very wary of trying to time the market. Yes, there are negative signs here, but there are also some positive signs. I think that it makes sense to continue to invest our money for as long as we can. Now, if you're one of those people, like I have been, that are expecting a stock market crash somewhat soon, being honest with yourself, how long have we expected that to happen? I know I've expected it for at least a year, probably longer. This is what the stock market has done over the past year. Over the past 1 year, as of the day of the release of this video, well, it's up more than 20%. Over the past year to date, it's up more than 28% because we had a big pullback in December. So we would have missed this move if we had waited to invest. So I'm a big fan of not trying to time the market, just go out there and do it. Now, if you're curious where to start investing, we're actually doing a series now called Dividends for Passive Income, where we are going through each of the 11 sectors and trying to analyze the top handful of dividend stocks within that sector. There's great companies there. There's also great companies in the comments of those videos. So if you're curious a good next video to watch, this playlist could be a good place to start. There's a link here. There's a link in the description below. Besides that, thank you so much for sticking with me all the way into the video. If you could, hit the thumbs up, hit the subscribe button. Don't forget to hit the bell icon so you get notifications. It really, really helps the channel. Thank you so much, and I'll see you in the next video.